Hi there. I want to share 10 amazing hacks which will enable you make more money in the stock market. By making more money, I'm not promising you any money is going to be falling into your account. Simply put, you will be able to minimize losses and improve on your ability to make profit. Because at the end of the day, in any stock market, investors are aiming for two things: share price appreciation and also possibly getting dividends. If you are able to implement these 10 hacks, you'll be in a very good standing. And I'm saying so because most of the times in the stock market, even in other forms of trading, people don't enter negative or on the red because they don't have a lot of money to invest. They do that because of habits. They haven't nurtured good habits which can assist them be able to make money. And that is why in this video, when I share these 10 hacks with you, they're going to help you be able to make money, guys. Okay? You are all much welcomed to my channel. In case you are new here, my name is Afagza Sifunam. I am a finance expert and qualified accountant, making amazing videos for you each and every day around investing, making money, breaking concept down for you in a very simple language in a way you can relate. So in case you love that kind of content I make, down there, consider subscribing. There's a button called subscribe. Click that button and subscribe to this particular channel for you not to miss any of my future videos. And I will still add it, drop a like on this video. Thanks for subscribing and also liking this video. And with that, the very first hack for you is, first of all, understand what you are getting into, understand what you are doing. You need to buy a business, not tickets. The biggest mistake people out there do is that they buy tickets, they don't buy businesses. Case in point, if I can ask you, if you're an investor, all the stocks you have in your portfolio, do you understand the business behind them? If the answer is that I understand some, others I don't understand, that you are miscalculating. As an investor, you need to have deep understanding of the business you are getting into. Because if you're not understanding the business, why are you buying a stock of a given business in the first place? Okay? And then, secondly, get into businesses which have competitive advantages. In case, for example, in your stock market, okay, there's a business which even last week did amazing numbers. Just because it was an upward trajectory, it doesn't mean it's going to continue doing well. What if they didn't have competitive advantage? Or even so, what if it was a monopoly and the sector has been opened up? Maybe also the same last week when it did amazing numbers, 2 more businesses were established in that particular sector. That is going to mean your investment is going to go south. That's why you need to invest in understanding the business you're getting into and continue getting or absorbing fundamentals relating to the business, okay? Then, the second tip for you is that let position sizing protect you. What do I mean? Simply put, don't be dumb when you're getting into the stock market or whichever other market out there. Position sizing can protect you. To give you an example in Kenya, in case you're new to investing, I would tell you, for example, you only have 5 million Kenya shillings, okay, in your saving or even your entire net worth. And then you take 5 million, you put that 5 million in a given stock at the Nairobi Security Exchange. That is going to be quite a foolish move. Because yes, you might have an upside, but a single investment from you putting money on a single investment is extremely risky. That is why you never let your lot size or your investment size protect you. You can put a small amount of money, okay? And even that way, don't put all your money in one bucket because that way you won't be allowing a lot size to protect you. There is that individual stock and also additional stock. Think of juggling up things a bit, but the most important thing, don't put all your money on a single ticket. That is not wise. Because what if you put your money there and then it goes down 30%? It's going to be a big exposure for you, okay? And then the third tip or hack is that use a written investment thesis. Simply put, what is your philosophy or thesis for you to invest? Right? Are you just investing because you had people out here invest? What is your goal for you investing? Are you investing? And even so, you're investing for how long? All these things need to be written down because I still believe there is power in writing down things. If you write things down, you internalize them, you own them, you have a basis of even holding yourself accountable, as opposed to just getting into the stock market because people are trading. Have your own philosophy, write down your thesis, okay? And then the fourth hack for you is you need to focus on earnings growth. Remember, I told you there are two ways to make money in the stock market: through share price appreciation, basically shares going up and down based on sentiments, okay? And the second way, through dividends. So you need to focus on earnings. Don't just focus on share appreciation. In fact, according to me, share appreciation most at times in the stock market is noise because it is based on sentiments. Right now, a share can jump 10%. You put your money on it, and then 3 days later, it crashes 30%. You lose your money. But if the business behind it is solid, those are, yes, quite related, but also independent to some extent because a business could be profitable, but the sentiments are not that good in the market. This business can still be able to show a part of his profits to pay shareholders. That is why you need to focus on earnings growth too. Don't just look at share price appreciation. Are the earnings of a company doing well? If they are doing well, have they been paying dividends? Chances are, if they've been paying dividends, the earnings have been doing well, the potential for growth is there. And that is probably a good stock for you to put into based on valuation as opposed to you speculating. Okay? And then the fifth hack for you is that you need to build in stages. Don't be greedy. The same way I said, don't put all your bucket in a single stock. Build in stages. No one is chasing you, okay? If you have 1 million to invest, no one is telling you, get your 1 million and put all of it in the stock market today. You might even decide to say, I'm going to be putting 100K each and every month. In investing, that's what we call dollar cost averaging. You can build in stages. Of course, over time, some people might argue, in case price is going up, you're going to be trading up. Basically put your average price of acquiring the stock is going to increase up. You'll be averaging up over time. That's fair enough. But then again, also, even if you're averaging up, you're going to be mitigating your risk. That is why you trading or getting in stages is very important. Don't just get to your 1M, that's the entire amount of money you have to invest, and then throw that particular 1 million in a single stock and hope for miracles to happen. Markets do dip and increase. Purpose to buy dips, okay? And then the sixth hack for you is don't hesitate to cut losses for the correct reason. Just because people out here advise you invest for the long term for you to enjoy the benefit of compounding, do you also realize you can enjoy the benefit of compounding through losses? That is why, for example, if you have very solid reason for you to cut losses based on both technical and fundamental analysis, don't hesitate. Of course, I'm always a champion of people investing for the long term. But then again, there come situations where, for example, the business story changes completely. Don't hesitate, okay? And then the seventh tip is that let winners continue running. The same way I've told you, don't hesitate cutting loss. As a sixth tip, the seventh tip is for you to let winners to continue running. If a company is showing you it is appreciating in its share price, okay? The company fundamentals are telling you the business is good. That is a winner for you in your portfolio. Let the winner continue running. Moments of maybe market crashes or even slight dip in prices shouldn't shake you because the bigger gain is in both share appreciation and possibly you also getting dividends. So let the winners run. Don't stop the winners, because if you stop the winners, these are the ones which are bound to contribute to your portfolio to enable you continue doing well. So let your winners run, okay? And then the eighth tip for you is that you need to have a reserve in your investment. What exactly do I mean? Just to see, for example, the way banks out there have reserves, also in your investment, you need to have reserves. And by that, I specifically mean you need to have a cash reserve to maintain dry powder for your market corrections, okay? And I'm saying so because you shouldn't be forced to sell when markets are going down. Ensure you have some cash reserve for you to deal with these dry runs, because at those moments, as I've said, markets do crash. And in case you're relying on that money in the market, chances are you're going to panic. and maybe release the money in the market because you're panicking, what if you lose the entire money? And that's the reason why you are always advised, only put money in the stock market, the money which you are able to leave it to stay there for a long period of time. Okay? Don't put money there with the aim of you cashing out next week. That's not you investing. That is you gambling. If you're putting money in the stock market, put money there knowing very well you can even leave it there for 1 year, 2 years, you name it. But if you're putting money in the stock market with the aim of you cashing out at the end of this week, that is not wise of you. The only moments where I can say that can work, but also is a very big risk, is in case someone is taking very huge positions. They have very insane amounts of money, maybe even millions of dollars. Through that, even if the margin is 1% or 2%, 1% of $1 million is a good amount of money. Compared to you, for example, putting in the stock market 10,000 Kenya shillings or $100, and then you want to cash out after 2 days. What are you doing? Chances are even the transaction fees themselves exceed the returns. So you're going to be shooting yourself in the foot. And that is why you need to have cash reserves for other endeavors or even you pursuing market correction in case you need to do that. Because that is going to go a long way in enabling you to be confident to have the money to put in the stock market stay there for some time. Okay? And then guys, the other tip for you, which is the 9th tip, is that learn from every trade. Out here, we have amazing investors who don't learn. You could have put money down maybe on a given stock, okay? Taken a given trade, whether it's a long position or short position, when it comes to a given stock. Things might work out for you. Rarely do people reflect why some things worked out for them. And more so, if things work out, people do ignore what went wrong along the way. Learn from every trade or any position, all the positions you take. Understand why you took that particular position. Did it work? Why didn't it work? If it worked, why did it work? Also learn from your wins. Don't just learn from your losses. Because you learning is going to enable you refine a strategy for you to be able to continue investing in a better way and even so increase the potential of making money with you investing in the stock market or even alternative investments out there. And then the 10th tip for you, which I think is extremely important among all these tips, is that learn to engage in the stock market or whichever trading out there you're doing without emotions. Emotions are the biggest derailers or killers of investments in the stock market. In case there is negative news in the stock market, why should you panic? Given you already know, you've done your own research, there is a history of stock markets out there crashing, but also those crashes are followed by recoveries. Why should you panic? Or even so, if there's a media company out there saying stock of a given company is going to be in big danger, why should you panic if your technical and fundamental analysis says something different? Maybe that news outlet is saying so because they have been paid to obtain clicks. And remember, behind the scenes, in higher clicks, also they get ad revenues. What if they've been paid? In case you do your own research, which I encourage you to do at all times, you believe in a given stock, you have your own strategy. Try your level best not to invest with emotions, because emotions are going to make you do crazy things in the market. Emotions are going to make you do panic selling. Emotions are going to make you do panic buying. Emotions are going to make you chase losses. And in the process, you'll end up losing more and more money. That is why you need to mitigate emotions as you continue trading. Of course, it's not easy, but along the way, continue refining your strategy and also working on your emotions. That way, you'll be able to become a more robust and lethal trader or investor in the market. What do you think about these hacks? I hope you've gotten some hacks in here which are useful, which you can implement for you to be able to increase and improve your investment over time in the stock market or even whichever other markets out there. Cheers, guys, and you all stay safe.